Airbnb announced its Q3 earnings this past week, and the result? Well, it was a little mixed. There was a market sell-off, and this is highlighting something that really I wanted to flag at the start of this episode, which was around this price to perfection problem that seems to be plaguing the American equity market at the moment. From my perspective, the market has been pricing optionality as inevitability, and it's showing some very obvious signs of weakness. If we just take a look at some other examples here, we had Meta sell off during its Q3 earnings result, down 13% in the past month, given the large AI investments with no proven return. Netflix too, the darling Netflix, was down 8% due to softness in subscriber growth and insider selling. Duolingo also fell a staggering 40% in the past month, with its AI-first strategy lifting share price only to have slowing user growth. And Pinterest, a company we covered on this channel just last week, saw one of its largest single-day losses after reporting earnings, with the stock down 16% over the past month. So while the S&P 500 may be reaching all-time highs, it's clear that the surface is starting to bubble. Now, I want us to watch this clip of Jeff Bezos when it comes to the importance of understanding the business first rather than chasing stock prices. He really captures the importance of this perfectly.
At the peak of the internet bubble, our stock peaked somewhere around $113. Okay. And then after the internet bubble busted open, our stock went down to $6. It went from 113 to 6 in less than a year. So my annual shareholder that year starts with a one-word sentence, and that one-word sentence is the word ouch.
So most of those internet companies of the dot-com era are out of business.
Yeah.
You survived. What was it that made you to survive, and virtually the rest of them are gone?
That whole period is very interesting because the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
Now, I love the line that Bezos says there, which the stock is not the company. He highlights the importance of tracking internal business metrics, number of customers, profit per unit, defects. These were all improving despite the stock price going down. So many investors chase price. They invest in the stock and not the company. And this is completely backwards. A winning company is driven by accelerating improvement to its key internal business metrics, not the stock price. And while this seems obvious, and investors know this, why do so many of them end up getting burnt in the stock market? Well, because while it's obvious that understanding the business is priority above chasing price, it's hard to do in practice. It's hard to understand a business as outside investors. This is due to the limited information that we have available. We don't have access to monthly management accounts tracking these key internal business metrics. It takes extensive due diligence and investigation to establish credible data on internal business performance, all of which takes time. And not only time, but the skill to be able to collate all those data points and triangulate to establish a best outcome. That's why I'm an advocate of owning one company first. A lot of people will go own the index route, and that's fine for your longer term retirement plan. But when it comes to developing your skill as an investor, I am a big advocate of owning one company first and understanding everything there is to know about that business. Become an expert in that company. As you grow your expertise in understanding the business as an owner and scaling your position over time while deepening your knowledge of the business and its internal process and metrics, you build the required conviction to know why you own what you own. And in the examples I've given here with Meta, Duolingo, Netflix, and Pinterest, it illustrates the importance of understanding the business first and letting the price come to us as investors, especially when it comes to these more medium cap firms, where if there's slight volatility or miss in terms of expectations, we see massive compression in the share price multiples. Now, in all four of these examples, the underlying fundamentals of the businesses have actually improved. So the stock has gone down for the past month for all four of these. But if we look at the actual key metrics of all four businesses, they improved last quarter. Duolingo saw a recovery and growth in monthly and daily active users. Yes, while they were softening, it continued to grow. And management have guided that they are focusing on the right opportunities for the business, looking at its long-term prospects. And so what does this have to do with Airbnb? Well, it's exactly where I want to start this video. We want to understand the Airbnb model. We want to understand the key metrics and see, are they moving in the right direction? This is where I really want to emphasize the purpose of these episodes is to train us to think like owners. We understand the business and we let the price come to us. And so what does understanding the Airbnb business look like? Well, very quickly we can see that we need to cover things like the business model, how they make cash, the capital discipline around management's ability and quality to manage this business, the scaling bottlenecks, what are the actual constraints preventing this company from doubling in size today, the behavioral traps that investors tend to fall in with these companies, and there are many. And finally, a verdict. Once we've established our understanding of the business, is this something we want to own, watch, or avoid? And right then, only then, once we've come to that point, do we look at what the market price is telling us about the business. So let's start with section 1. We look at the business model. We want to cover just in one sentence what the business does. We want to look at the customer problem, who's paying us, why they're paying us, why they keep paying us. We want to look at how $1 of revenue flows through the business down to owner cash, how we actually get a return here. And we also want to look at the moat and durability of the business. Is this something that they can defend as they grow? Now, without getting too convoluted, Airbnb is a simple textbook marketplace. It needs two things. It needs to drive liquidity, which is the volume of transactions that go on the app, and it needs to drive the take rate. This is how much of a percentage they take of the volume. And just to make that concept really simple and clear, if we just look at like a normal real estate broker, if they're selling homes, the more homes they sell, i.e. the liquidity, the more commission, i.e. the take rate, they take. More liquidity, so more homes being sold, higher commission, more percentage of that sales price coming to the broker equals more revenue for the broker. And the same here is for the Airbnb business model. They need hosts to host their homes on the platform. They need guests to then book those homes on the platform. And that booking is the gross booking value, or GBV. See that as the sales price of the house. Airbnb then has a take rate, which is effectively their commission for bringing the host and guests together on their platform. So when it comes to customers, we have two. We have the hosts, and we collect a fee from the hosts for hosting on there. And then we also have guests. Now, if we look back at what Jeff Bezos was saying around the internal business metrics of Amazon, management will tend to highlight these in their filings. And in the case of Airbnb here, they've got a section in their report that says key business metrics and non-GAAP financial measures. Point being is here, management have highlighted to us as investors what they believe are the important business metrics to monitor. Now, it's up to us to apply a judgment and say, are these really the most important ones? Are there perhaps underlying drivers that these are dependent upon, and actually those would be the primary ones? Regardless, they've said here that the nights and seats booked, as well as the gross booking value, are their primary metrics. And why are they their primary metrics? If we look at nights and seats booked, they use it as a measure of the scale of the Airbnb platform. And then finally, if we look at the gross booking value, as we said earlier, that's the liquidity, right? That's the dollar value of the bookings, and that is the liquidity on the app. Both of these elements are crucial for growth of the business. So how does $1 become owner cash? Well, if we look at the latest cash flow statements, what we've got here is we've got the opening cash, we've got the cash that was generated from operations for the quarter, and we have the sale of investments that also releases cash. And we look at have all the total available cash there. They had about $21.3 billion worth of available cash in the business to figure out what they're going to use it for. Most of that they park in investments. These investments are just marketable securities so that the cash that's not being used can at least earn some interest income. The largest actual cash outflow is around share repurchases, and we will touch on that later. And then otherwise, they've got sales and marketing, cost of revenue, operations and support, product development, general and admin, and a slither of CapEx. So very light model in terms of operations and operational costs. When it comes to how we actually generate a return, the only area where management has indicated that they will return is through the share repurchases. There's no dividends, there's no other return that we receive as investors. That share repurchase is how we get a return on our capital. So when we look at the moat and durability of the Airbnb model, it's driven by two primary functions. We've got what they call network effects. These are businesses where the more users you have on the platform, the more users are attracted towards the platform, and you have this exponential growth in user base. And the second point is around brand and trust. And we have to combine those two. So we've got the liquidity between the hosts and guests and the brand and trust that we have for those users on the platform. That is the Airbnb moat. That is something that's challenging for any competitors to replicate at scale, which Airbnb has successfully done. The moat dies if user experience and trust in the platform erodes to a significant level. And yes, there are always cases of people complaining about the service that was delivered either from the host or the guest perspective. But what we're looking for here is a fundamental breakdown in that experience. So section 2 of understanding the business, we look at the capital discipline. And this indicates, are management acting as good stewards of capital on behalf of us as owners? Now, there are good examples where management are acting with capital discipline. Most notably, we have the active shrinking of share count, and actually the share buybacks or share repurchases that are being performed outpace the dilution that's being caused by share-based compensation issued to the executives. Another factor is that the margins are expanding. Revenue is outpacing cost. And if we look back at the cash flows, we saw they had a very light operating model. Low sales and marketing, low CapEx, low general and admin costs. And this means that as the user base grows, as revenue grows, that operating margin expands. And finally, the balance sheet is rather prudent. They have minimal interest expense. They're self-funding through the cash flows that they generate from operations. And this creates that flywheel where they can continue to invest and grow without being exposed to debt repayments. And that is particularly important in tough times. Should we be facing a recessionary period at some point in the future, which we will, the business's balance sheet is in a position where it can get through it without having to make arrangements or compromises with their debt. But there are some governance risks, as always, with every business. In particular, if we look at the share-based compensation, it represented about 15% of 2024's revenue. So there's significant pressure on the business in terms of share-based compensation. And while the share count is shrinking due to the share repurchases, this is still an area that us as owners would need to pay attention to. And then secondly is employee control. And something we actually saw with Pinterest as well. But in the case of Airbnb, the execs own approximately 80% of the vote, with the CEO, a single individual, owning 30% of that business. So really, us as voters would not have a say in how this business is run. Overall, what we like to look for is, are our incentives aligned? Is management incentivized and aligned with us as owners? Overall, Airbnb management is partially aligned with us in that the cash pay is restricted and the equity stakes are large, but the share-based compensation and the RSUs for non-execs and concentrated voting power require owner scrutiny. So these are the focal points for us, and to see that these are not growing out of control. So in section 3 now, we look at the scaling bottlenecks that Airbnb is facing. What are the factors that are preventing or constraining the business from doubling in size today? Well, there are a few. The primary one is around the regulatory environment that Airbnb faces itself. Right? Management have noted that there are significant onerous restrictions on operating these accommodation services, particularly in key cities like New York and others. The regulators are very strict on short-term accommodation. They're trying to promote an environment where people can actually live and work in their cities and not be extorted for doing so. And the entire Airbnb model was initially around that short-term stays. This has resulted in Airbnb looking towards the more longer-term stay metric that was partially spurred on through the 2020 environment, but that has now grown due to the regulatory pressure as well. So that's the primary constraint. What is management doing about it? Well, for the most part, they are actively spending in policy initiatives and engaging with the regulators on the matters. They are disputing these factors. They are highlighting the fact that it restricts growth of the business and how it actually doesn't benefit the end users. Beyond collaborating with the regulators, we'll see that they have to accelerate their growth in regions or territories where they aren't exposed to such regulatory pressure. Beyond scaling in these other regions, this is why management has actually spurred their services and experiences line, which is outside of accommodation and more in line with travel in general as a wider user experience of the platform. So in section 4, we look at the behavioral traps that investors find themselves in when analyzing this company. And in particular, we're asking ourselves, what is the lie that investors are telling themselves about Airbnb? And well, boy, Airbnb really is a textbook example of narrative fallacy. We had the CEO announce that he wants to make Airbnb, quote, the Amazon of travel. Well, the investors lapped that up and the stock surged on the back of that CEO's announcement, right? We saw the stock rise and the Amazon of travel motto be absorbed by the market. And I really wanted to highlight how it goes all the way from the CEO down to the individual retail traders. And I mean, the last point here, I've got a Reddit comment where it says, quote, I'm going in on Airbnb. Love the concept of being the Amazon of travel and building this company over the decades. So you can see how the story really grips individuals and they're willing to put their capital into a business because of the story. Now bear in mind, Airbnb's fundamentals at that point in time hadn't changed. The only thing that changed was the story and the price went up. And so this is a clear textbook example of narrative fallacy where the story is greater or has greater weighting than the actual math or fundamentals of the business, right? That Amazon of travel was widely amplified across the investing universe. Management guidance state that the services and experience product, which takes them out of that risky accommodation area, has no near-term revenue or profitability in sight, right? It's actually dragging margins down, but despite margins being compressed due to a new service line and management having to split their focus between accommodation and services and experiences, despite that, the share price went up. So how do we as investors mitigate ourselves when it comes to these behavioral traps? Well, one, when we look at the business here that was capturing others, such as the services and experience aspect, strip it out of our models, strip it out of cash flows, assume it generates no returns. Look at the core model. Are they still growing it? Are they still improving the user experience and moat around that business? And then secondly, we need to ensure that we incorporate the regulatory constraints in the business into our thesis, carefully monitoring the progress with the regulators and seeing how that impacts Airbnb's ability to supply accommodation in these key cities. So in section 5, we now have what's called the verdict. We've established some fundamentals about the business, and we want to know, is this something we want to own, watch, or avoid? Now, we saw that they've got a strong self-funding cash engine, right? They are generating positive free cash flows that they're able to invest and grow into the business. And they aren't reliant on external debt. They've got an established moat with a marketplace at scale, driving high liquidity between their hosts and the guests. Management has demonstrated that they're largely disciplined with the capital and returns they generate on the business. But we've identified that there's that real regulatory scaling constraint, right? If that isn't managed effectively by management, this business will struggle to grow at double digits. And then finally, we've identified this behavioral bias that's around the Amazon of travel narrative fallacy, right? This is overweighting the stock price and something that really isn't something that should be priced in by investors at this point in time. The math just isn't there to substantiate it. So that puts Airbnb as a watch. Now, what would make us want to own it? Well, if we look at these factors that put it as a watch, within the moat, we want to see the continued liquidity growth. We want to see that gross booking value grow over time at a good rate. We also want to see it grow in the key regions where they're having regulatory pressure. We want to see management reduce that share-based compensation pressure that they're putting on the owners. Again, think about it. The execs are paying themselves tens of millions of dollars for their job, and that's fine. They're running a business, they're growing a business, they're generating a return, but it is significant compensation. At 50% of 2024 revenues, that's a hell of a pay package. When it comes to scaling, we need to see tangible growth post-implementation of certain key legislation. In Europe, they've got this pricing disclosure that mandates that the price is fully disclosed to users so you can see where the fees are going and who gets what. That enhanced transparency typically raises scrutiny by users as to who's raking in the money, but we need to see if that impacts from a behavior perspective, if that impacts the users at all or not. And then finally, the Amazon of travel narrative fallacy. This needs to go away, or it needs to be evidenced, in which case the price is justified. Now, finally, now that we understand the business, we know this is something that is worth watching at this point in time, and we know what our risk-on triggers are. Now we look in section 6 at the price, right? This company first, price last. And if we look at the share price of Airbnb at this point in time, we want to analyze where are they aligned with our understanding of the business and where are they not aligned. In terms of alignment, they have got that premium treatment of the cash engine, which is justified. The positive cash flows, the ability to be self-reliant is worth a premium. There is that volatility around near-term margin drag due to the services and experiences offering. We saw this now in Q3 this past week, that the share price dropped due to an EPS miss despite revenue growth. And then finally, the market is factoring in the regulatory concerns around short-term rentals and those scaling constraints on the business. But where are they out of alignment? Well, we've identified the biggest one, which is this Amazon of travel headline, right? It doesn't imply frictionless growth. There is execution risk and there are scaling constraints. Just because you've got a nice new flashy story doesn't mean that the numbers can justify the new re-rating of the share price. And then finally, the market is celebrating the share buybacks as a blanket good positive news story, but there is that nuance about the fact that there are significant dilution by share-based compensation, and that needs to be continually monitored by owners of the business. And that takes us to the end of the Airbnb analysis. Now, I hope you enjoyed this episode. It really was interesting to go through the Airbnb business model, understand the primary factors around it, how it works, what the moat is like, what management is like, what's keeping it from growing today, and then looking at that against what the market is saying about the business and see whether this is something we want to own, watch, or avoid. I hope you enjoyed the episode, and I'll see you in the next one.